Hey everyone, welcome back to Poprageous. I'm Danny Alex. So Disney released their first quarter 2024 financial results, and surprisingly, their stock popped almost 15% on the news. What was in their financials that made their stock go up like that? Well, there are some very interesting things to say the least, and in my opinion, Bob Iger was trying hard to spin Disney results after the bell. Little background on me, I'm a screenwriter here in Los Angeles and worked on Wall Street for a number of years as a market maker and analyst. So let's jump into Disney's 2024 Q1 financials. So here we are for immediate release, February 7th, 2024. It came after the close of trading on February 7th. The Walt Disney Company reports first quarter earnings for fiscal 2024. Now, there's a lot of information in this, and we only want to go through some of the important things, some of the bullet points before we get into the guts of it. And this is interesting how they word this. Listen to this. Revenues for the quarter were comparable to the prior year quarter at $23.5 billion. What that means, it's a nice way of saying our revenues didn't grow. And therein lies the biggest bomb. If your revenues do not grow, but your earnings per share grow, basically you're saying we had no ability to grow our business. We only increased our earnings per share because of cost cutting. Cost cutting only goes so far. So if you cannot prove to Wall Street that and analysts that you're not increasing revenue year over year, there is no reason for your stock price to go up. There is no reason whatsoever. And that's what I found. And even, if you know Kramer off of CNBC, I don't agree with them all the time. He has some important things to say. I think a lot of the time, some things that are dumb, but he said the same thing. The other thing that they want you to hear is diluted earnings per share, EPS, for the quarter increased to $1.04 from 70 cents in the prior year quarter. So last year, first quarter, 2023, it was 70 cents earnings per share. This year was $1.04. And again, all facilitated by cost cutting. Firing people, closing things down, all the Star Wars things that they shut down. Disney stock had no reason to go up. Why did it go up? I'll give you two reasons why Disney stock went up. Sellers fatigue. There comes a point where there are just no more sellers left at the $80, $90 level, even the $100 level. And with the market going up so much, especially in the AI side, and the market's starting to show wider breadth in terms of which stocks are starting to go up, it had to be a really bad earnings report for this thing to go down. I mean, it really did. You've got sellers fatigue, and then you probably also had a short squeeze. And based on those two things and a little bit of Bob Iger spin and, talking up the stock, talking up DTC, direct-to-consumer Disney Plus, is probably why the stock actually popped. The other thing, some other important points they wanted to make here is our first quarter earnings results reflect the progress we've made in our strategic transformation as we continue to build from a position of strength. Strategic transformation just means we're raising hell in a company. We are cost cutting. We are eliminating thousands of jobs. We are closing this, closing that. We are achieving significant cost reductions across our businesses, as evidenced by the realization of over $500 million in selling, general, and administrative and other operating expense savings across the enterprise in the first quarter. Now, I would have thought it would have been a lot more, and that's why I was a little surprised that they only got 34 cents per share earnings per share rise out of their cost cutting in Q1. Maybe that's going to accrue in later quarters, but with all the things that they were cutting costs on, I was really surprised that it was only that. And here on the next item, they say what they're trying to do. We are on track to meet or exceed our $7.5 billion annualized savings target by the end of fiscal 2024, while we continue to look for further efficiency opportunities. Meaning, we're just looking for more ways to cut. That's all that's saying. They're looking for $7.5 billion. If they can find $9 billion to cut, they'll do it. Because their only way to grow this company, or at least their earnings per share, is by cost cutting. Because as we know, if their top line doesn't grow in Q2, they're going to be in trouble. They're going to be in trouble. Right now, the market is giving Bob Iger the benefit of the doubt. And here are two more pieces of information that I think are pretty important. It deals with Disney Plus, their direct-to-consumer division. And they say we continue to expect to reach profitability at our combined streaming businesses in the fourth quarter of fiscal 2024 and are making tremendous progress in this area. The first quarter entertainment DTC operating losses improving by nearly $300 million versus the prior quarter. We believe this business will ultimately be a key and earnings growth driver for the company. And it did. They really did. They increased their costs. The cost of Disney Plus, merged it into Hulu. I don't know how much of an effect that had in the first quarter, but they did make a tremendous strides in almost getting that thing profitable. At least not losing as much. And then Hulu subscribers, so this is important too. Hulu subscribers increased by 1.2 million from the prior quarter. Disney core subscribers, Disney Plus core subscribers decreased sequentially by 1.3 million. That's not a surprise. That is in line with prior guidance. They were expecting that. I know some people are trying to spin that, oh, look at Disney. Like, come on, at least you got to be truthful and sensible. That was expected. That was no surprise. They gave us that information 3 months ago. So if it decreased more than that, I would have been surprised. But that is not to say we don't know the guts of this. Hulu increased by 1.2 million and Disney Plus decreased by 1.3 million. That's not to say that Hulu was 600,000 and maybe it was 1.9 million. I don't know how the guts of this company works. I don't know how they report. We don't know the guts. This is the information they give us. There's no way to qualify it. At the end of the day, it's GAAP numbers. These are the numbers that they pull out of their systems and that they deliver to us. So who knows? Now, the one last thing that I'm going to give that is, I think, really important going into Q2 next year, we expect Disney Plus core subscribers net additions in Q2 of between 5.5 and 6 million for ongoing positive momentum in ARPU, average revenue per user. Very important number, ARPU, in the second quarter. So in the second quarter, they are expecting 5.5 million to 6 million. Why? I'm guessing on the password crackdown, password sharing. Netflix has done this incredibly successfully, which is why they've been increasing the last quarter. That's been the majority of Netflix's growth, has been in crackdown on password sharing. So I think Disney is going to crack down on password sharing. They do that, their average revenue per user is probably going to go up. Their number of users is going to go up, and they're going to be that much closer to profitability. So let's get into the numbers. So here we are at the top. We have a message from our CEO, Bob Iger. You can get into the financials. You can read that. I'm not going to read it, but it's right there. You can go to Disney Investor Relations, and you can see their Q1 2024 release, and you can read this thing. It's 23 pages long, so it's a lengthy document. Summarized financial results. So here they summarize the financial results by on the macro, broad strokes. Revenues for the quarter. On this Q1 2024, $23.549 billion. That's just for the quarter. I mean, that's $100 billion, almost $100 billion per year. That's a sizable amount of revenue. But $23.5 billion last quarter in the prior year. 0% change. And this is the problem. This company has no right for the stock price to go up. It should have no earnings premium because it is not growing top line. If you can't grow top line, you've got problems. So we'll see what happens with the stock price. It's going to have a hard time holding on to these levels unless some really good news comes out. Income before income taxes, $2.8 billion. And earnings per share, $1.04. Diluted earnings per share, excluding certain items. Certain items means one-time charges, basically. And then cash provided by used in operations, $2.185 billion. And free cash flow. Basically, they took a lot of their cash flow. Actually, that probably went to the Hulu purchase, that $2.1 billion, with free cash flow of $886 million. You can see the prior year on this quarter, it was not very good. But anyway, that's the key takeaway. That's not good. That's not good. And here we go. Summarize segment financials by segments. They have three main segments: entertainment, sports, and experiences. Entertainment is their catalog, their the studios, all that kind of stuff. So here we see in this quarter, it actually shrunk. Entertainment shrunk by what? $700 million, 7% shrinkage. You'll see the golden goose. Where the golden goose is in this company. And do you know where the golden goose is? I bet you know. So there you see shrinkage. And of course, the studio is doing terrible. Terrible. Sports, $4.8 billion. Slight increase from last year. That's basically just ESPN. They have an India company. I'm not sure if that's, but it loses a ton of money, that India streaming company. And there we have experiences, basically parks. And they should just put, instead of experiences, just put the golden goose. $9.1 billion, $600 million growth, 7% growth. Of course, they increased ticket prices and everything like that for $23.549 billion in revenue. And segment operating income, very important. The operating income per segment, $874 million operating income in entertainment. Now, that is primarily because they had much smaller losses in the DTC, Disney Plus, because the studios did horribly, as we know. The movies for Disney and the final, like it was Wish and the Marvels. Not a whole lot of income there, a lot of losses. Sports, $103 million loss at ESPN. I wonder what that's from, because ESPN is profitable. And of course, here we are, my friends. The Golden Goose, $3.1 billion from the parks. Without the parks, this company is nothing. Nothing. And here we go to the discussion of first quarter results by segments. We're just going to touch on each segment very quickly. The linear, so in the entertainment, you have the linear networks. Now, the linear networks are actually very profitable still. They're a declining thing. I think they have ABC. I forgot what all their linear networks are. But ABC is their main one. 2.8 billion. Direct to consumer, 5.5 billion. You see the growth. It's got 15% growth. And content, sales, licensing, and other 1.6 billion. That is a decline of $1 billion. A lot of it is box office. They had Wakanda Forever and something else, I think, in the prior year that really boosted Q1 in 2023 for a total of 9.9 billion. There's your profitability. Linear networks, $1.2 billion in profitability. Direct-to-consumer lost $138 million. Content, sales, licensing, and other. That's your studios. That's your content library, everything like that. $224 million loss for an $874 million profit, which is a increase from the year before. That's where the guts of it, in terms of the entertainment side, is started. So if they get the DTC, the Disney thing, which they might do, because I always thought putting Disney Plus into Hulu and buying Hulu. At first, Bob Iger was talking about scrapping it. I could not understand that strategy. Hulu is solid. I mean, it is solid. I'm thinking about changing. I use Hulu. I'm thinking about changing to YouTube TV. Not big on Disney. Not a big fan. Don't like a lot of the things that they do. So I'm looking at changing to YouTube TV. But anyway, that is the entertainment side. We don't need to worry about the linear network. Let's get into the meat of this stuff. Sports revenues and operating income loss are as follows. So here you see revenue domestic. It's ESPN. That is majority of the revenue in the sports division, $4 billion. International, $363 million. There's your Star India. Look at the losses on this thing. Star India, revenue of $399 million. Total of $4.8 billion. Domestically, $255 million profit in ESPN. That's pretty low. I wonder why. That's a little surprising. $56 million loss internationally. And here's your Star India. I know they're trying to sell it. I don't know who would want to buy an asset that has $400 million in revenue with a $315 million. That's annualized. You have a $1.2 billion annualized loss. Who wants that asset? Not me. Thank you. And here we are, my friends, to experiences, aka the golden goose, the goose that laid the golden egg. If Disney loses this, if this asset turns lower for whatever reason, for the economy, for branding issues, for whatever, Disney is going to be in trouble. As long as they have the parks, they're doing fine. And I think they have 3 Disney ships, cruise ships that they're building. I don't know how those are doing. They don't give any specific numbers that I saw on how their cruise ships are doing. But if their parks ever turn down, they're in trouble. It is the cash cow. So here you see experiences, revenue in the parks, domestic, almost 6.3 billion. A slight increase, 4% increase. International, this is where they grew their parks, 35% growth in the international parks, 1.4 billion. Consumer products, that's selling all of your, your Disney teddy bears, your Disney Mickey Mouse, all that stuff, 1.4 billion. I mean, that's a pretty good business in itself. You're looking at almost $6 billion in annualized revenue from consumer products. Not bad. For a total of $9.1 billion in revenue, it's a 7% growth rate from the prior year of 8.5 billion, which is fine. So net profit, look at that, $2 billion from the parks, domestic parks. $2 billion, all of their profits come from their parks. $3 billion from their international parks, and $328 million and $700 million in profit from their consumer products for a total of $3.1 billion, a growth of 8%. That's Disney, my friends. It's the parks. Without the parks, this company would be in massive trouble. And that's why they're spending so much on their parks. It's a smart thing I would do that. Of course, I would do a lot different things with the studio. But their parks can sustain the entire company as they slosh along and make, develop useless content, terrible content for the studios. They can stay woke a long time. Their studio will not make this company go down. The studio could lose $2 billion per year, and it's still going to be a profitable company. Now, if they turn that studio around and actually making content that people like, instead of going for story instead of message, you're going to see a huge change in this company. If I was the CEO and I really cared for shareholders, that is what I would do, because you've got some really good performing assets here. And you make that, imagine remember in 2019 when Endgame came out? They netted almost $15 billion net that year. Net, $15 billion. Last year, it was about $4.5 billion net. This year, I think they're shooting for about $6 billion net. Their net revenue has dropped dramatically, the Walt Disney Corporation, from 2019. But if they continue to erode their intellectual property by releasing, you build intellectual property through the movies. This is how you develop great characters that you can monetize in your parks. But they're not going to take that Wish character and monetize that character in the parks because no one cares. They're not going to take the Miss Marvels and monetize them in the parks. Maybe to a certain degree. I mean, there's some people that like them, like the movie, watch the movie. It's an opinion, so some people are going to have a good opinion. It was a terrible movie, and it didn't create intellectual property. Disney Endgame, Marvel's Endgame. When you take a look at Captain America, Iron Man, the Hulk, all the Black Widow, those characters have intellectual property developed over phases 1, 2, and 3, and they can monetize those characters in the Disney parks. They can't monetize Marvel Phase 4 and 5, and that is where they're hurting themselves. That's the big thing that I would read into why the studio business is really hurting this company and will continue to hurt this company. It's because they're not developing any valuable intellectual property that they can upsell in their parks. But right now, the goose that laid the golden egg, the theme parks. And now we get to the actual financial statements, and this is where we're going to see the macro results. We've already seen basically the statement of income. Top line revenue, here you see December 30th, 2023, which is Q1 2024. December 31st, 2022, which is Q1 2023. We've seen this, basically the zero revenue growth, which is why this stock should not have popped. Probably maybe not a bad shot. I'm not telling you what to do with your money. Could have been a good short there at 110. Sometimes you want to let these things play out. Cost expenses. Here you have your income taxes, $720 million in income taxes. Yes, big companies do pay income taxes. I get sick and tired of hearing from people that these companies don't pay income taxes. They do. And you take the sales tax they pay and the other things they pay. These companies, I always ask people, have you ever gotten a job from someone who makes less money than you? Think about that. The more rich people there are and the more rich companies there are, the better the job markets will always be. You may not agree with that, but it's a matter of fact. Net income attributable to, don't need to know that. Here's your net income attributable to Walt Disney Corporation, 1.9. After you put everything through the ringer, 1.9 billion. Earnings per share on a fully diluted basis, $1.04. Again, 34-cent increase from all that cost cutting. Zero revenue increase from all that cost cutting, 34 cents. I would have said, you know what? You're staying at 95 bucks. There's no reason for this thing to have popped. But sellers fatigue and short squeeze. That's why I attribute it to 1.835 billion shares outstanding in this company. Now the balance sheet. Here we go, the balance sheet. So let's take a look at the important things. Cash on hand. How much money does Disney have in the bank? They have $7.192 billion, down from $14 billion from last year. What happened? They bought Hulu. So I think the $2 billion that was taken from cash flow in Q1 plus $7 billion here, I think the bio was about $8.5, $9 billion for Hulu. There's your decrease in cash. They bought it from Comcast. Net receivables, 14.5 billion. One thing that's really important here, I don't know if you ever heard of a current ratio, current assets versus current liabilities. One of the most important metrics. They are less than 1. I always like to see at least a 1 or higher. I think most people like to see a 1 or higher. But here you have all of their current assets. Current assets are basically assets that can be converted into cash within 90 days. Total current assets are 25.9 billion. Basically 26 billion, right? Ish. And here you have, produced and licensed content costs. You have some intellectual property, that's, goodwill stuff. In the value of their names and brand, total assets of $197 billion. But the important thing is their current assets. Let's remember that number, 25.9 billion. If we scroll down here to their liabilities, and this is kind of interesting. Accounts payable and accrued liabilities, $18 billion. Their receivables are only $14 billion. So here you have a $4.5 billion difference. If you squeeze that through the ringer, you kind of take a lot out of cash. You'd only really have, less than $3 billion cash. But anyway, let's continue. Current portion of borrowings, deferred revenue, and other total current liabilities, $31 billion versus $26 billion. That is a $5 billion below 1 differential between current assets and current liabilities. I don't like to see that. No one likes to see that. Of course, they have a lot strong free cash flow right now with the parks. But that's something they got to improve on. And the big number here, $41 billion. That's their, that's how much long-term debt they have. Primarily from the Fox Studios purchase back in 2017. And remember, the only thing really Bob Iger has done for Disney, he's purchased assets. Hasn't really grown assets, he's purchased assets. He purchased Marvel, he's purchased Star Wars, he purchased Fox. And the majority, I think the Fox was like a $50 billion worth of debt that was put onto the Disney's balance sheet. And it's not accruing positively onto earnings, far from it. So that's a big number to watch, 41 billion. $500 million interest payments, they can easily pay that. But you basically put that through, and your total liabilities and equity have to equal your assets. 197 billion, 197 billion. So those are your main things you want to take a look at. We'll go on when Q2 comes out. We'll take a look at how these numbers change, and specifically see how how they're managing their money and how operations from Q2 affected their bottom line. And the final one is the statement of cash flows. It's basically, there's a difference between earnings per share and statement of cash flows. Your statement of cash flows is your cash, your bank accounts, like your actual money. In EPS, there are non-cash charges that go through amortization, depreciation. Depreciation is things that if you drop on your foot, it's going to hurt. Amortization is goodwill. And these things they're backed out to give you a free cash flow number. Cash and cash equivalents and restricted cash beginning of the period and end of the period. Here we have cash used in financing activities. Right here, acquisition, redeemable, non-controlling interest, 8.6 billion. So that's where all your cash went, your purchase of Hulu. To leave us with $7.2 billion in the bank. Was that a good move? I think it was. I would have bought Hulu. The integration with Disney Plus and Hulu is, that is smart. At first, Bob Iger didn't want to do it, and I couldn't understand that. They wanted to sell Hulu, but now they're integrating it. So I think that's a good move. So we'll see how that. So the important things in Q2 is going to be how Disney Plus and Hulu combined, how that works out. Do they get it profitable? Password crackdown from the password sharing, that's going to increase revenue. And I think this is maybe where the street is giving Disney the benefit of the doubt on their stock price. If Bob Iger can thread the needle on this stuff, we know that the studio is not going to have a good quarter. We know that for sure. But if he can thread the needle on the DTC, the direct-to-consumer, get the ARPU up, average revenue per user, and crack down on the passwords, if he shows anywhere near profitability with a $5.5 to $6 million subscriber increase, I think that's where the street is saying, you know what, we're buying now and we'll see later. That's the only thing I could think of because the revenue is terrible. And again, the goose that laid the golden egg. If anything ever happens to the parks, this company's in trouble. But as long as they have the parks, they've got a strong bedrock of cash that comes in that will finance a lot of bad decisions. But investors and shareholders are getting tired of it. They used to have 15 billion in net revenue in 2019. So we'll see where Q2 goes. I'm going to try and do this for other companies, Warner's and maybe Paramount and Netflix, to go through the numbers and to get a sort of a good idea of what all the guts here. It's a good idea to see what happens in the guts of these companies. So maybe I'll start doing more of these. Thanks a lot, guys. We'll see you in our next video. Cheers.